It's another awful day for the cryptocurrency markets. The market is still nervous following the massive sell-off caused by the insecurity of stablecoin UST. This stablecoin exploded a few weeks ago after failing to maintain its one-to-one peg with the US dollar. UST is now worth less than $0.45. Terra's protocol's Luna token, which was developed by the project to aid with the preservation of Terra USD's value, is similarly in shambles. Luna, which peaked at $119.18 in early April, is now worth less than a penny, having lost more than 99% of its value in the last 24 hours. The losses are significant, with Luna currently trading at $0.01. This came after Bitcoin fell to a low of $36,675 on February 21, when fears of a Russian invasion of Ukraine pressed on all major markets. Stocks, bonds, currencies, and other assets, for example, all plummeted at the same time. Some of these assets are still declining, but Bitcoin and other large cryptocurrencies are making a comeback. Only oil and gas prices are rising, and they appear to be unrelated to the overall market collapse. Hey folks, while you're watching this video, don't forget to give it a thumbs up and also subscribe to this channel. One reason could be that Russia has not yet attempted to take over Kiev, Ukraine's capital city. Even though its military forces advanced into eastern Ukraine on February 21, perhaps the hope is that the threat of sanctions will deter an all-out conflict in Ukraine. Even though there is now a definite Cold War, Bitcoin appears to be climbing on the expectation that an all-out hot war would not break out. But where Bitcoin is headed in the future? The possibility of catastrophic war in Ukraine remains very high. This prospect may trigger an increase in fear, uncertainty, and doubt in all markets during the following few months. The truth is that a big market meltdown is a definite possibility, especially with a hot war in Ukraine. The price of oil will increase, raising concerns about a global recession and economic downturn. According to some, quote-unquote, 90% of cryptocurrencies will not survive the next market meltdown. Those who remain, which are likely to include Bitcoin, will be stronger and will continue to dominate the market. To be fair, according to Decrypt, several analysts now believe that Bitcoin is in a long-term bear market. One cause is a drop in Bitcoin platform activity. Bitcoin is facing lots of new challenges. As a result, these analysts anticipate that the Bitcoin cryptocurrency will not rise anytime soon. For example, the possibility that the Federal Reserve will begin raising interest rates soon may make other interest-bearing assets highly appealing. Because Bitcoin does not give any formal interest income, it may appear less appealing. It is nevertheless a store of value. In the face of growing inflation, gold is regarded as a reliable asset. Similarly, digital currencies such as Bitcoin could help investors protect asset prices during a prolonged bear market. And now is the time for investors to consider the potential of a bear market. The clouds of war, Russia, inflation, rate hikes, controversy in Canada, rising oil prices, and tensions with China appear to be gathering to limit global economic development. Where does this leave Bitcoin crypto investors? Bitcoin cryptocurrency investors should carefully assess where they believe Bitcoin will end up in the next months. Will it continue to fall? Is the current rise in BTC crypto a hint that investors regard it as a haven in times of extreme fear? After all, Bitcoin has been through several severe crises in the last 10 to 12 years. In times of uncertainty, I have learned to average down into assets that I want to own in the long haul. As a result, only on that basis, now might be a good moment to buy more Bitcoin. Furthermore, BTC Bitcoin is an appealing starting point for investors who are new to the digital currencies. When there is a large degree of uncertainty, this approach must also be followed, buying long-term investments. This is true for purchasing Bitcoin right now. You might believe that 2022 is going exactly as Bitcoin investors hoped. The global economy is weakening, weighed down by chronic supply chain pressures, rising inflation, and the risk that interest rates may rise more and faster than almost everyone predicted just a few months ago. Bitcoin fundamentalists say that central bank measures cannot destroy Bitcoin since coins are mined and sold by large numbers of unconnected individuals. As a result, they are beyond the reach of coordinated acts that could jeopardize their fundamental value. Furthermore, because of its restricted quantity, Bitcoin, like gold, should be resistant to inflation. Bitcoin supply is algorithmically limited to 21 million coins, with over 90% of them already in circulation. So, although inflation reduces the purchasing power of paper currencies such as the dollar and the euro, the value of a Bitcoin should remain relatively steady, all else being equal. When extra money is printed, the value of Bitcoin should climb in paper money terms. But what we've seen is a much more intricate picture taking shape. Bitcoin has fallen by nearly a quarter since reaching a record high of $69,000 last November, even though nothing fundamentally counts against it. While the Federal Reserve is considering shrinking its balance sheet, central banks continue to produce extra paper money overall. The fact that Bitcoin has become a kind of a poster child for short-term speculative investors squares the circle. Its development in recent months has been uncannily similar to the rises and falls laid out by America's technology-laden Nasdaq index, itself a rough indicator of market sentiment. That is, Bitcoin has done well when investors are most confident in the global financial system, not when they are most concerned, which is the inverse of what we may have predicted. Many cryptocurrency investors believe that Bitcoin is a digital era version of gold, a potential flight to safety investment, and an inflation hedge. However, cryptocurrency price behavior implies that the market does not regard these extremely volatile assets as reliable stores of wealth during times of economic instability. Gold has historically had an adverse association with stock prices, which has so far played out as expected in 2022. While stock prices have declined, gold is up about 3% in 2022, while the S&P 500 is down around 16% year to date. We've seen similar abnormalities in gold before. For example, when the epidemic first hit in March 2020, gold abandoned its safe haven status by falling precipitously. This was attributed at the time to panic, which caused investors to sell their most liquid assets regardless of the fundamentals. Positively, Bitcoin's hash rate has just reached new highs, surpassing 200 trillion hashes per second. The hash rate is proportional to the number of miners in operation, the difficulty of confirming a transaction, and ultimately, the network's security. Furthermore, Bitcoin may play a crucial role in mitigating the consequences of inflation in the long run, not least because its annual rate of production falls by around 50% every 4 years. This puts Bitcoin on an unstoppable path to scarcity that even gold cannot match. Even if theory implies there shouldn't be one, there's no doubting that current nexus between Bitcoin and big tech. We shouldn't anticipate the road to digital currency nirvana to become any smoother or more predictable, nor should we expect the need to diversify across several asset classes to become any less essential. Fears of chronically rising US inflation and the possibility of extraordinarily harsh Fed actions to combat it have fueled stock market selling pressure. The Consumer Price Index, or CPI, increased 8.3% year-on-year in April, the greatest level of inflation in the United States since 1981. Earlier this month, the Fed hiked interest rates by 50 basis points to a new target range of 75% to 1%. Fed Chair Jerome Powell stated in his post-announcement press conference that more 50 basis point increases were on the table for the next 2 FOMC sessions. In addition, the Fed will begin authorizing $30 billion in US Treasury securities, and $17.5 billion in mortgage-backed securities will be phased out beginning in June. According to Brian Price, Commonwealth Senior Vice President of Investment Management and Research, the path of least resistance in risk assets remain to the downside for the time being. Quote-unquote, the overriding attention remains on inflation, rising interest rates, and the situation in Ukraine. Price says, quote-unquote, the market is now devoid of major positive catalysts, so it's no surprise that we're starting the week under pressure. The stock market sell-off confirms that investors are looking for shelter from the possible negative economic impact of the Fed's tightening, but not in the cryptocurrency market. Investors should keep in mind that the opinions offered may no longer be current and may have already been implemented. The information provided in this video is not intended to be personal advice for any specific investment. Currency exchange rate fluctuations will have an impact on overseas assets. Thank you for sticking with me to the end. If you appreciated this informative video, please like and subscribe to this channel for more.